All right, we have another green day for markets today after a negative GDP, putting the country into a technical recession, although not a real recession, a deep recession. And the Fed, Treasury, and the administration is not calling it a recession, but it is by technical definition 2 negative quarters of GDP. But not by much. So we haven't seen mass layoffs or companies closing, things like that, that typically indicate a real deep recession. And the question is, are we going to get one? I know there's a lot of confusion out there because the markets were up on the Fed decision to raise interest rates, which oftentimes the markets bounce on Fed decision day because it's exactly what the Fed telegraphed and expected. They do not surprise the markets. They indicated they were serious about fighting inflation. And some of the markets were interpreting the Fed as dovish and almost a pivot, although the Fed did not pivot and did not indicate they were going to pivot. They said we're going to continue to raise rates, but we see that we're at neutral according to current rates right now, meaning not a more accommodative Fed or less accommodative Fed, kind of neutral, and going to watch the data to see what lies ahead. And, we can't predict where the economy is going to be in 6 months. The next meeting is going to be in September. We also have our next inflation report in September, which is probably going to show inflation for the most part is plateauing. However, I don't think it's going to come down because rent inflation will be in the next inflation print when it was not in the recent one because it's lagging. Even though fuel prices have come down a little bit, they're still at pretty high levels. Nothing else is really coming down. And from the earnings that we've seen released so far this quarter, from last quarter, the forward guidance, future guidance is that all costs are up, all costs continue to go up, and everybody's gonna have to raise prices to keep up with that. So we could be seeing a plateau in inflation. I don't know that we're going to see it go much higher, but I don't think we're going to see it come down either, at least not for until the end of the year, maybe going into next year. So we'll just have to see how things go. And the Fed thinks or said that they've done enough to affect inflation, but it's going to take time. So they want to kind of just see what it looks like, watch the data in terms of not providing future guidance, but they did not say we're going to back off, we're going to pivot. They may keep it just as it is if we get another strong inflation print. So right now, markets rallied on that news from the Fed, and they also rallied today on a negative GDP because generally the day after the Fed raises, as we looked at the other day, you get a down day, you get a reversal the next day after the Fed bounce. So there was a lot of short covering today going on, and earnings short coverings. So Apple came out, beat earnings. So Apple is up pretty good after hours right now. Amazon just came out. Amazon had a loss, but their storage business, AWS business, was up, and they had good guidance on that. So the stock actually bounced. Roku came out. They missed on all levels and put pretty poor guidance out. So they're down 25-30%. We'll take a look in just a minute to see what's going on there. So a couple other reasons the markets are up here the last couple of days is because obviously short covering when a lot of investors thought the markets would be down today. And also hedge funds, investment funds, they're trying to make up for lost ground. There's a lot of losses in the hedge fund industry right now. So they have to take big risks. They have to go risk on the rest of the year to try to make up for the losses and hopefully stave off redemptions at the end of the year so they can stay in business and stay employed. So we're going to see how that works out. And the other thing is the big money. Where is the big money right now? Big money is right here. You see the bonds at 2.67%. We've been talking about that lately. Treasuries, the 10-year Treasury falls after the GDP reading shows negative growth because large investors are worried and concerned about inflation. The yield curve is still inverted, meaning shorter term treasuries are paying more than longer term treasuries. That means that there's a big worry from bond investors, which are your life companies, your institutional investors, the big money that you need to really drive the stock market, drive the crypto market, that major capital that's looking for safety, moving into treasuries to try to protect capital while the market figures itself out. So that's another reason that well, that's one of the reasons that the market, so is this a sustained rally? So that's what I was going to say. Can this rally sustain? It needs this capital to come back out of treasuries and go into the stock market in order to sustain any kind of a longer term rally. So is this a bear market rally? Is this a reversal? Where are we at? Right now it still looks like a nice bear market rally. It's within the percentages, we'll look at that in a minute, of typical bear market rallies. But U.S. government debt prices rose on Thursday after the preliminary GDP reading for the second quarter showed an economic contraction. The yield on the benchmark 10-year slipped by 6 basis points. The 2-year fell to 10 basis points, which continued to inverse that yield curve. Second quarter GDP came in, it slipped 0.9%. So basically, the market moves today came after the Fed decided to raise rates by 75 basis points for a second time in a row to combat high inflation. And in addition to the Fed also said the U.S. economy is not in a recession. There are just too many areas of the economy that are performing too well. So that pushed stocks higher. But arguably the smart money is hedging against recession and downturn, to determine whether this will be a sustainable rally. So let's take a look at what's going on in the markets. Bitcoin's continue to have a nice bounce here, playing with that $24,000 level, trying to break 24,285, 24,3, depending on the exchange, to get above that level and try to turn this into support and try to continue upward. So we'll just have to see if Bitcoin can do that. It is playing with that 200-week moving average right now. Let's take a look at that. So at the moment, price is back above the 200-week moving average. And when we go back to the daily, it is above the 50-day, which has been playing as kind of resistance, quasi-support resistance, as it's been following that line downward. So we'll just have to wait and see if markets can sustain the momentum going into tomorrow. And right now, the Dow, and here's what we talked about. So the Dow Jones, if we look at from the peak, these bear market rallies that we've had so far, we looked at this the other day. They are, that was about 8% there. This one overall was about 9.8%. Last one before this last leg down was 8.5%. And then right now, this one is coming in at 9.7%. So typical bear market rally overall. The NASDAQ, I think, has seen a bigger bounce right here. This rally was 17% back in March. And right now, this current rally from peak to trough is about 15%. So NASDAQ is coming in, par for the course. S&P, the last big rally again was back in that March timeframe. And from peak to trough, wick low to wick high, about 12.6%. Right now, it's coming in at 11.9%. So nice bear market rallies. The question is there enough momentum to sustain? Will tomorrow be a down day or an up day? And lots of short covering going on. So let's take a look at a couple of things here. Let's take a look at Apple. And here is Apple after earnings. You can see Apple popped about 5% here after earnings reported. It's about 4%. Roku, as we said, lost on earnings. You can see, whoa, Roku looks like Terra Luna right there when that was going down. And let's take a look at Amazon. Amazon had a nice little pop on their earnings, as did, I put Amex on. Here's Amazon right here. Nice little pop there. Let's take a look at that. Kind of like Microsoft the other day, actually missed on earnings, 12.9% for Amazon. So that's a nice little pop for Amazon. Will it sustain? Can it keep going? We'll just have to wait and see. It's had some nice little balances at this bottom area here where it's trying to figure out the next move in the process here. And there is your March 2020 low right here. So Amazon's playing down in that level from March of 2020, which a lot of these assets are. So, again, the big question is, can markets sustain the momentum tomorrow? And for Bitcoin, we're looking at kind of the same type of action we've seen all the way through as Bitcoin continues to level down each time. So the question is, are the markets going to put in a base here at these levels and try to find some sort of longer support to consolidate in this area? potentially consolidate up a little bit, or is this just a stopping point until the next leg down? And a little bit more earnings coming out, things like that, short covering going on. So we're just going to have to wait and see. There's no way to know for sure. There's just a lot of things out there that could potentially derail the markets. Obviously, we have the war in Ukraine that could escalate, especially with the grain situation that's going on. We still have recession that hasn't set in yet. We have inflation that's not going anywhere anytime soon. What the Fed has done has not really affected inflation yet. With bond yields dropping, with bond rates dropping, that's bringing interest rates down. The housing market is correcting. I'll take another look at that tomorrow, but not significantly enough to really affect the housing market yet. Those mortgage rates need to be in the 6 to 7% range to really affect housing. And we'll take a look at that tomorrow in a separate video. But we still have recession risk. We still have inflation we're dealing with. None of that's been fixed. And the Fed has not pivoted, although the markets are interpreting some of what the Fed said as a pivot, but it's not an actual pivot. So we'll just have to keep our eyes on those things. So these are the things I'm looking at. We will see tomorrow be a big day to see if we can sustain the upside momentum, start putting a base in, and just kind of consolidate here for a while and wait for any other macro headline news, risks, things like that as we get into the fall and the winter. Obviously, energy is going to be a big deal. Food's going to be a big deal. And consumer spending is going to be a big deal as people are running through savings, racking up credit through the summer because people were getting out, spending money in the summer, taking those vacations, enjoying the time right now coming off the last 2 years of the pandemic. And, those bills come due here in the fall. So, a lot of these things are lagging in terms of real effects on the economy, real effects on the market. So it's going to be an interesting fall going into the winter for the markets to see how this quarter finishes out and what Q4 is going to look like. So these are the things I'm looking at. I'll see you in the next video.